You know, most of us pay for insurance, whether it's car insurance, health insurance, life insurance, or even pet insurance. But have you ever stopped to wonder, how exactly do insurance companies make money? Today on Business Unboxed, we're going to break down how insurers turn risk into revenue. And spoiler alert, it's not just about taking your money and hoping you don't file a claim. Let's unpack it. First, let's understand what insurance actually is. At its core, insurance is a business of risk pooling. You and millions of other people pay a fee, called a premium, to transfer your financial risk to the insurer. In return, they promise to cover you in case something bad happens, like a car crash or a house fire. Now here's the thing, not everyone will need to make a claim. In fact, most people don't. And that's the basic math that insurance companies count on. Imagine 1,000 people each pay $500 a year for car insurance. That's $500,000 in total. If only a few people get into accidents that cost, say, $100,000 in total claims, the insurer is left with a $400,000 surplus. That's called underwriting profit, and it's one of their main revenue streams. Insurers use very sophisticated models and tons of data to predict how much they'll need to pay in claims. The more accurately they can estimate risk, the more profitable they become. But that's just part one. Part two is what really surprises most people: investments. Insurance companies don't just sit on the premiums they collect, they invest that money. This is called the float. While they're waiting to pay out claims, they invest the money in bonds, stocks, real estate, you name it, and they earn returns. Warren Buffett talks a lot about this in Berkshire Hathaway's insurance businesses. Even if the underwriting breaks even, the float generates billions in investment income. So now, insurers are making money in two ways. First, by charging more in premiums than they pay out in claims. Second, by investing those premiums and earning returns before they ever need to use them. But wait, there's more. Insurance companies also earn fee income. For example, some companies manage retirement plans or sell investment-linked insurance products. They charge fees for managing those funds. Plus, there's reinsurance, which is basically insurance for insurance companies. Insurers spread out their own risk by paying other insurers to cover big events. This allows them to handle large catastrophes while keeping their own books stable. Now, you might be wondering, isn't this business risky? What if there's a natural disaster or a pandemic? Great question. That's why insurers have strict regulatory requirements. They need to hold a certain amount of capital to ensure they can pay claims, even in worst-case scenarios. They also adjust premiums regularly and use reinsurance as a safety net. So, what are the biggest threats to their business model? One is mispricing risk, charging too little for too much risk. Another is fraud. Then there's the risk of poor investments, because if the float doesn't perform, the whole model gets shaky. But when they get it right, insurance is incredibly profitable. That's why you see giant insurers like Allianz, AXA, and State Farm with billions in revenue every year. So to sum it up, they collect premiums from millions of people, they pay out claims, but far fewer than the number of customers. They invest the money while it sits in their accounts, and they manage risk better than most people on the planet. That's how insurance companies make money, not by gambling, but by mastering probability and time. Now that you know, the next time you pay your insurance bill, just remember, you're helping fund a financial engine that's been running for hundreds of years. And that's the business Unboxed.